I can't help but read this and go, unfortunately, the bad capital allocation over the past decade is so extreme that between the government and some parts of the financial markets, we have to clean that up and then maybe just hope that that mess doesn't impinge on the benefits we could enjoy from better capital allocation in the next decade.
Yeah, I think that's right. The transition could be very, very painful. There's a lot of, zombies out there that have been propped up. You're already starting to see some of them fail. Inflated asset valuations, those are correcting. A lot of leverage needs to come down. It's going to be painful. I'm hoping we can pull off the proverbial soft landing and make this transition not too painful. But once we do get to the other side, it's going to be better for the economy. Absolutely.
And let's talk a little bit about that. So, because I think the implications actually run quite deep. This isn't just, I genuinely wonder about like the size of Wall Street, the size of financial markets, like all of this private equity. There's industries that more than doubled in size built on a business model, especially theirs, which relies on low floating rate debt, that now you wonder if it's sustainable. And the answer may depend in part on how long rates stay up here. If we get a recession and we're quickly back down to 2, 3, or 0, I guess it won't matter.
Well, but that's actually my nightmare scenario, because then we go through all this pain of tightening and trying to get inflation under control. And then just because we've got this huge bloated, financial sector of these private funds that have grown exponentially, we go back to easy money to bail them out, and then we're right back in the soup then. So right. I think it's going to be hard. I think it's going to be very hard. But it will make us, there's no really empirical evidence that low rates boost economic growth. You can't find the correlation. Some of our strongest periods of economic growth have been characterized by high rates. Mm-hmm. There's this kind of mythology that, low rates stimulate the economy. You get a short-term bump, and it's certainly appropriate if you're in a financial crisis situation, but longer term, it's a drag on growth. So I hope we can see the wisdom of that, be patient, think long-term. We haven't done that for a while, but think long-term. Hold on to the reins and get to the other side, and then we'll be better off.
Right, and I should add, it's not as if you're saying, high rates right now are going to be so great. I mean, you sound as cautious about the environment as anybody, talking
absolutely.
About credit cards and kind of what's and banks. We haven't really checked in on the banks in a while, but again, we didn't think rates were going to be up here, and their earnings are around the corner, and other than the ones with capital markets, I don't know what they can point to.
Yeah. Well, actually, the higher rates for traditional lenders, those that take deposits and make loans, higher rates actually benefit that model so long as, your yield curve is inverted. So some steepening of the yield curve now is actually probably going to be healthy for the banks. But yeah, they've got some transitional issues too. They've got a lot of low yielding assets on their balance sheet, unrealized market losses, increased pressure on their deposit funding costs, a lot of competition from money market funds and other places, government, where you can get a really good rate on a virtually risk-free asset for government money market fund. So they've got some challenges too. But again, longer term, I think it's going to be good for traditional lenders. That will be good for small and medium-sized businesses who tend to get their credit from those banks, not from the capital markets.
So do you kind of think that, looking at the back half of this decade, the picture looks a little bit brighter, or overhanging all of this is what's happening on the kind of the fiscal side of it?
Yeah, well, the fiscal side is a real problem. And regardless of what the Fed does, if we can't get our federal deficit spending under control, that's just going to keep pushing rates up and up, regardless of what the Fed does. So, yeah, and what's going on now in Congress doesn't give you a lot of hope. They can't even put a budget together. And it looks like we're probably, because of this mess with McCarthy, the extremist won. So we're probably, again, looking at a government shutdown in November. It is beyond my imagination, having worked for Bob Dole in the 80s when Congress really functioned, the government really functioned. To see what's going on now is very sad. And I can only hope we're close to hitting bottom. They're going to figure out the lunacy of their ways, straighten up their act, and put us on a fiscal sustainable path. On inflation, there are things they could do. A more rational immigration policy. We've got a demographic problem, tight labor markets. A part of that is just being driven by the demographics. A sensible immigration policy where people who want to work and contribute can come to this country legally. That would make a lot of sense. But we're so far from even having that kind of discussion. Housing supply, too. What are we talking about there? Not much of anything.
Right.
So sorry, go ahead.
No. Go ahead.
I was just saying there's a lot on the inflation front. We're putting it all on the Fed. There's a lot on the inflation front that a functioning Congress could address, but that's hardly even part of the political discourse right now.
So the last thing I want to ask you about, the Supreme Court, on top of everything else going on, the Supreme Court this week did hear oral arguments in which the plaintiffs are arguing the CFPB, the Consumer Financial Protection Bureau, is unconstitutional because its funding comes from the Fed and not Congress.